the day after. Yeah. So Rob, where are you this fine Friday afternoon?
Want to give it a guess?
Let's see here. There's a pier in the background. San Francisco, I'll go with.
San Francisco, eh? I thought it was raining out in San Francisco. Well, Rich, you are correct. I will swing the camera a little bit. Okay, so we'll go over here
Mazda.
and
the Golden Gate Bridge. Wow, look at that. The
there you go.
sacrifice you make for the show, the listeners and the viewers. You're on location, scenes and settings. I love it. So good.
Assignment.
And for our podcast listeners, where most of you listen, still don't join us live on Fridays at 3 p.m. Eastern, you're missing this beautiful scenery of the Golden Gate Bridge in the background. Rob on location in San Francisco this week. So, well, happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. And as always, pleased to be joined my esteemed colleague and co-host, Rob Chrisman. Rob, great to see you. Great setting.
Good to see you too. Do you want to tell the folks playing along at home what is your Christmas ornament strategy, since they're all still up?
The strategy is hopefully get it down by Feb 1, more realistically, probably mid-Feb. So, but just being realistic. So
sometime in February.
Yeah. That's as much as I'm willing to promise. So my bachelor days, I would just keep them up year round. It made decorating very easy every year. So
yeah. And we've talked about how appraisers laugh at appraising houses where Christmas lights and ornaments are still up in July.
I can see, honestly, yeah. I took my blow-ups down in the front yard. That really could hurt the value. So yeah.
I hope hopefully they were holiday themed.
It's most of them. So
oh boy, we're
going everyone.
Going down the wrong path here quickly. Yeah, get us back on track, Rich.
Get this thing back on track. So Rob, let's start. Big news yesterday, the long-awaited release of the new Fannie Freddie delivery fees, aka LLPAs, aka loan level price adjustments. And immediate reaction, just we deal in honesty here, a little bit of robbing Peter to pay Paul. Between 640 and 680, definitely some breaks, in the bands over 70%, but every delivery fee bucket for FICO's over 680 and LTV's over 70, aka about 92% of the loans the GSEs buy. Delivery fees went up. You add that on to the increased fees we got in the spring on cash out and investment properties and second homes. And, so it looks like, this whole repricing exercise for the GSEs more maybe let's stoke the coffers and build the case to get out of conservatorship than it is we're going to help these home buyers on the fringes in this time of a lot of challenges to home affordability. Am I off base or?
Oh, you're spot on. But what's the other game in town? There really is none. I'm sure the non-QM segment of our industry didn't mind that announcement. There is a little bit of a plus, and I don't know if you're going to get to this, but when you look at the securitization fees, as best I can understand it, back in the day, like a couple of years ago, Freddie Mac loans went into Freddie Mac securities, Fannie Mae loans went into Fannie Mae securities, and then they made a uniform mortgage-backed security to be able to combine both, and there was a fee to combine loans into one security. Yesterday, we learned that they are scaling that fee dramatically back. It's actually an improvement. So Sorry, there's a poster flag. In fact, you all. I don't know. Can you see that?
Yeah,
Maybe not.
yeah.
Anyway, and so there was a little bit of relief there from companies that securitize, but with the declining volumes, fewer companies are actually securitizing loans right now. So there was a little bit of a plus, but not dramatically so. But you're right. The email traffic that I saw following the announcement was basically look out FHA. You know, FHA will see a shift in their volume based on this. And, I'm sure the government is, well, I'm not sure the government is cognizant of how changes in one delivery mechanism impact the other parts of the mortgage ecosphere, as it were. But yeah, you're right. It's a hit. I think overall it's viewed negatively by the industry. But once again, what are you going to do about it? Unfortunately, it's one person wrote and said we don't, they've got us over a barrel here. We just have to take what they dish out. So
A little ironic as the government and the FTC assesses monopoly potential cases in our industry. They're kind of, using their heft and the lack of other alternatives to sell conventional loans to here to, as you noted, Rob, kind of push the poker chips around the table a little bit here. The commingled security fee, many would argue that should have been gone years ago. Good to see it was finally reduced, not eliminated. But also they added a general subordinate financing, just general fee. These are for the 8010s, the 8015s. We are going to see a metric shit ton of these loans in the next 3 to 5 years because of people that don't want to touch 30-year fixed rate loans in the 2s, 2.5. So they're going to lop on seconds, or they're going to, refi to keep the first under a conforming level. So that also was added. So yeah, kind of confusing a little bit because, listen, Sandra Thompson, you cannot have your ear more to the ground. And we love her. I mean, honestly, she is genuine. She looks you in the eye, and she has been at every forum that we have done of lenders, like willingly and wantingly, and sits there and take notes and interacts. So, but I think to her credit, I think the edict that she's dealing with, because I've heard her talk, not say this directly, but they can't, no new money anywhere. So if they want to reduce delivery fees to 640 to 680, basically Big Brother is saying, go find that money plus a little bit more just to be safe somewhere else, is my sense.
Right. No, I don't disagree or really have anything to add to that other than it impacts it. The ultimate impact is on the borrower, and the borrower is already paying, higher credit fees now. The borrowers are already paying for appraisal cost. I mean, it gets passed down. The lenders aren't really in a position now to take that increase and just eat it, given where margins and revenue are now. So, and it impacts business in general.
Maybe somebody in the chat, like rough ops people in the chat, the percentage of GS Fannie Freddie loans that are over 680 FICO that you use for scoring purposes and over a 70% loan to value. So over 680 and over 70%. I just would be curious if, you could put it anonymously, percentages in the chat. What percentage of those of the loans meet that criteria? Because they all just went up in fees. And, I've always said over the years, like Rob, we've bitched about it on here a million different times, like when they raised the G fees to pay for some tax extension. Not one media story about it. Other times that the government has kind of used American mortgage holders as piggy banks, like sneakily, that underreported, never reported. With all the attention right now on housing affordability in the housing market, I would be shocked beyond belief if one of the major media outlets does not run with the story that, if I think I'm right, like 80 to 90% of the loans in America are going to go up in costs in a time where affordability is the worst it's ever been.
I agree. I agree. You're not going to get any pushback from me on that. As I was saying, it gets pushed down to the borrower, but it also impacts vendors out there. Anybody who tries to, help the residential mortgage business, it impacts business in general. And I don't think but that all said, Rich, I think it might be kind of death by a thousand cuts. I was talking to a friend of mine who was dealing with a DMV licensing issue. This person had moved and had to jump through Department of Motor Vehicles hoops in terms of years of ownership or how new the vehicle was and how old and which county they lived in and so forth and so on. And, this fee and, $5 here, $10, little fees here, little fees there. And you just kind of grin and bear it because you want, you need a license for your car. And so it's not enough to dissuade people from owning a vehicle outright. Certainly buying the car itself or having a car payment would be enough to do that. But the little fees that get added on really add up. Just like in California, for example, California has an historically and a well-known low property tax rate, high state income tax, low property tax rate, but that's the base property tax rate. So what happens is you move to California, you think, oh, I'm going to have a property tax bill. And then there's let's build a new firehouse, a third of 1%. And we need a new library. So we're going to add that on there. Oh, we need, this and this and this. So little by little by little, that property tax rate gets higher and higher and higher. Same thing with mortgage banking. You have this structure out there that, little by little by little, we're up over $11,000 a loan now per the MBA. And this will just add on to that for a lot of borrowers. So it's, I don't, if you want to own a home, if you're, 32 years old and about to have a family and you're living in an apartment and the landlord keeps jacking the rent up, you want to own a home. And so, we got to pay a little, $100, $200 fee or $300, whatever, I want a home kind of thing. So I think it's just you're right. It's a little bit of a money grab, taking from Peter to pay Paul kind of situation. But as an industry, we grin and bear it and move on.
We're used to it for sure. And some stuff coming in the chat, over 75% of our business, 70% of our business, 80% of our business. These are loans that are over 680 and over 70%. All those loans got an increase in delivery fees. When you factor in the loans between 640 and 680 that just won't get a DU or an LP approval anyway, regardless of the reduced delivery fee or not, I would argue 10 times the home buyers will benefit or will be negatively impacted from these changes than those that will benefit. So again, at a time where many would argue affordability is the worst it's ever been, and people are actively trying to do things to improve home affordability. And then Rob, to your point, I mean, it's like the federal government has to know at the end of the day, they have to know that these changes are going to cause a massive influx of business over to FHA. This is not even withstanding the fact that lenders can make money on FHA loans a lot more than they can conventional loans. So you're going to see a flood of business to FHA. And I have to think to myself, it's so obvious that it has to be intentional, that the fact that they're trying and want to get the GSEs out of conservatorship, and FHA, the reserve fund is over 4 or 5 times what it should be, that this a calculated move, or am I giving the federal government too much credit?
I think you're giving them too much credit. But then again, big data, I would say that, many years in the past, people would have some kind of slight idea in terms of their book of business, how many loans are 680 or above or what, and so forth, to be able to slice and dice things. Fannie Mae and Freddie Mac are very, very good, as are, say, big banks and big investors, about knowing what their book of business looks like and where to tweak things to gain revenue and how to tweak something so as not to impact the flow of business. But I don't know, frankly, I'm dubious about the ability for the folks at HUD and Ginnie Mae and FHA to talk to the FHFA and say, hey, what are you guys doing? I would imagine the FHFA told, HUD what they were doing ahead of time, but I can't, you know, I don't know.
The hope,
Maybe,
I think
maybe
the
not.
leaders of those organizations all have worked together in the past. They have great working relationships together, have talked about the importance of kind of interagency communication. So hopefully that, this is maybe more of a calculated move. And we did get a reduction in FHA, insurance premiums. So we'll see what happens, and, kind of handily with that, 'cause it's big news, but
You bring up a good point, which I've been answering a lot of emails about, and that is or I'm sorry, earlier you brought up the point about how there was a guarantee fee increase. I think it was 10 basis points to cover it was like the highway tax something or other. This happened 10 years ago, 12 years ago. And nobody ever talks about that anymore, but I need to do a little research and bring it up again, because just like putting a toll booth on a road to help with some kind of, short-term project, and then the toll booth sticks around because the government likes the revenue. The government kept those basis points for many years ago, and nobody brings it up anymore. And I'm sure whatever project, whatever tax extension, I forget exactly what it was, is long gone, I think. And so, yeah, we just kind of say, oh yeah, well, that's the way it is. But
10 basis points in rate is like what, 40, 50 basis points in price. So 0.5% in price on how many mortgages have been done since then. That's you need like the national debt calculator to figure out how much they've gleaned unsuspectingly from American mortgage holders.
Right. Right.
Anyway, this is the rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman. Rob, more positive news. Mortgage applications up 28% week over week. Huge increase. You got 30-year fixed rates right around 6% right now. We've gotten some relief. The numbers continue to be good. Another good jobless claims number this past yesterday, just 190,000 first-time claims amidst expectations for 214. So, the picture right now that's being painted through these economic releases is one of, abating inflation with a still very healthy labor market, kind of exactly what the Federal Reserve wanted. So we're getting a little relief, and here's hoping it can continue as we get into the first quarter here. So
I hope so. Although between, I think, yesterday and today, or Wednesday, you've got Microsoft and Google. Microsoft laying off 10,000 people, Google laying off 12,000 people. You get enough of those in the high tech industry, and it starts to add up. I think the labor market has been very strong. The December jobs numbers were superb. Wage growth was slowing down a little bit. Unemployment was still low, and there are jobs out there. I'm not seeing quite as many for help wanted signs walking down Main Street USA as I did, say, last year. So some of that it'd be interesting to watch. But the job, yeah, in manufacturing though, Rich, I got to I've been a anti-recessionary guy for a while now, but some of the manufacturing numbers are a little bit soft, or are starting to show some softness. And when I saw that Microsoft thing with the 10,000 layoffs, I thought, well, yeah, I mean, when was the last time you bought a Microsoft product? I don't even know the last time I bought a Microsoft product was. Obviously Google's out there, but how many new phones or new laptops or Microsoft, software do you really need? And so we are seeing some weakness in the tech sector, and that's being made up for in other areas, fortunately. But yeah, it wouldn't be, a soft landing, wouldn't that be nice? We don't, from a capital markets perspective, we don't need this kind of stuff. Either, this kind of thing tends to be okay. And it's the volatility that hurts. So the market has been relatively non-volatile, although rates have come down markedly, which it's not going to last forever, but it would be nice to get back into the fives on average for 30-year fixed, and have home buyers accept that. And maybe at that level, I need to also look and see what student loan debt is, what interest rates are on student loan debt, because I think current mortgage rates are below that. So if you have a family and they're getting ready to go to college and you're looking at student loan debt, or refinancing your mortgage or getting a second, a HELOC or something, maybe it makes sense to use your house. I hate using houses for piggy banks, but sometimes things warrant it. And if rates, continue down a little bit, we may see more and more rate and term refis. I should say cash out refis, which will boost our business. So, at some point we'll get out of the winter, get into the spring, get into the buying season, the typical buying season. Rates come down a little bit more, maybe some rate and term refis. Things, maybe we will hit 2 trillion this year in business, which would be nice.
Yeah, and why we're spending so much damn time talking about just inflation in the broader economy, because really our industry hinges on that, because we need just a non-disastrous interest rate climate to be able to have a good year for our industry. It also helps the economy in so many ways, being able to refinance people and more homes being sold, and with that. So, it's, a little bit warmer than expected winter, rates starting to come down a little bit, all these good economic numbers in a row indicating, so I agree.
So,
If you get into the fives, I mean, all this credit card debt out there right now, I mean, you get the 5.5, 30-year fixed, and you're sitting on a truckload of 18, 19% credit card debt. All of a sudden refinancing out of 3% doesn't seem so crazy.
So let me shift gears here a little bit. I don't know. I can't even tell how much time we have left in our half-hour show. But one of the things that I'm seeing and hearing, talking to folks, it's starting to creep into the conversation a little bit. The dramatic layoffs, reductions in force, cutbacks, whatever you want to call them, firings. Those have died down. And what I'm hearing now is many companies are saying, if we get a little down move in rates a little bit, rates start continue to edge down somewhat, we don't want to be caught short-staffed. And many of the layoffs that were happening in the second half of 2022 were, new folks or untrained folks or just totally extra folks. And when you start cutting into the bone of companies somewhat, some of the more loyal employees who've been there 5, 10, 15 years, or some of the people who really know the systems and the policies and the procedures, it really starts to hurt. And as 2022 wound up, I was hearing from managers and owners saying, damn, I had to let, Samantha go. And she was really, she's going to make somebody a great underwriter, for example. Now there's more talk about keeping the Samanthas of the world on in the event that we do get so company, and she was telling me, I don't mind breaking even for a while, as long as I don't miss out on a potential upswing in volume. April, May, in the buying season, rates continue to creep down. So I'm starting to have that conversation and hear noise like that, that the big layoffs are over with, and that, companies are kind of hunkered down now. They're where they want to be, and they're willing to wait it out and see if things pick up a little bit. Of course, I'm saying this and watch, Finance of America will lay off 8,000 people tomorrow, or Monday, or but I'm starting to hear that more and more out there. Nothing definite, but something for viewers and listeners to kind of be cognizant of.
Yeah, same. I think, just the last 6 months of last year, every month got slower, so I think a lot of lenders, whatever your willpower to, adjust staff size, I think that a lot of people just said, we just kind of got this, get this over. I was talking to one of our members earlier this week, they had 115 employees a year ago, 60 today. I'd say that may be scale representative of the industry. And just, it's one of the things I just hate about this industry, because it just, it's brutal for leaders. And, I got to let go of one person. It's horrible for me. I mean, so I can't even imagine, what a lot of leaders had to go through this year. So, but yeah, I think you're right now. And again, I'll go back to what I've always said. I think right now, like, who owns the company? How much cash and capital do they have? What is their willpower for the mortgage industry from 2023 to 2028? Like, that's everything right now, right? Because you're right. I think you're seeing a lot of people right now, they're willing to continue to make no money or lose money to add scale, to hope that benefits them on the other end. So we'll see.
We'll see.
Got about 5 minutes left. Going to take it a little bit shorter this week. Rob, what else did we have in the news? The Wells Fargo fallout, sitting on 960 billion with a B, servicing. A lot of people are kind of wondering when that may, if at all, make its way into the marketplace.
So let me just throw out my 2 cents on that. And you've heard me rant about sensationalist headlines before about housing market plunges, and then you actually read the story and it's the appreciation rate has gone from 20% to 20% down to 5%, so that's a plunge, crash. San Francisco 2-bedroom condos have gone from 3 million to 2.5 million. Oh well, boy, that's a crash.
Drop in 30 years, right? Yeah.
So yeah, when you talk about servicing, Wells Fargo is not filled with dummies. If you were a major home, let's say you owned 10,000 units, Rich, near Las Vegas, and you're thinking, I've had a good run, rents have gone up, values have gone up, it's time for me to cash out. You are not going to sell all 10,000. You're not going to put 10,000 of your units in Las Vegas on the market all at once. Because it'll drive the prices down. You might put on, 20 a week, and however long that takes, or 30 a week. Wells Fargo, with its, servicing portfolio, it's highly doubtful if they are going to just throw it on the market and, hope for the best, because the number of buyers for that are very, very limited, very limited. So what Wells Fargo may do, if they decide to go that route, is, I think, sell pieces, little pieces, scale into it, sell things that they don't want in their servicing portfolio, 100 million here, 50 million, whatever the dollar amounts are, billion here, billion there, kind of thing, because you don't want to swamp the boat. You don't want to capsize the analogy. You just don't want to impact prices like in one fell swoop. So they may start to sell it through different channels, and it may be absorbed over time. But I don't, but it makes for a great headline, right? Oh, Wells Fargo is going to sell, $1 trillion worth of servicing. Well, yeah, look for the bid tapes, next week, kind of thing. That's not typically the way those things work.
Great points, great analogy. And owning a bunch of homes, they'll likely bleed it into the market slowly. And like the Fed, I think, with MBS, although they probably had so much amortization just these last couple of years, they probably didn't have to do too much of that. I haven't seen updates on the Fed's MBS holding, but similar thing there. What else we got in the news? Better.com still trying unsuccessfully to go public. Their SPAC just tried to extend some date for something that's still in the news. Everybody's suing cross country evidently, and the NBA still no clue what's coming its way with Matt Ishbia. I cannot.
Wait a minute.
I can't wait. Yeah, I can't wait. I'm telling you, it's going to be.
No, you didn't even use your boy, Matt Ishbia. I was waiting for your boy.
Listen, I saw it happen here in Cleveland with Dan Gilbert, who now he's going through some health issues and he's taking a back seat more. But let's not forget the Comic Sans Dan Gilbert letter after LeBron left, and why LeBron and Dan Gilbert had zero relationship. for years and still really don't, and why LeBron ultimately ended up leaving Cleveland. Ironic because they're staunch competitors and hate each other, but there's a lot of similarities. between
The
The-
Warriors will be playing them tonight.
okay. There you go.
the
The
goal-
logo. There it is.
There's the logo. The Golden State Warriors will be playing the Cleveland Cavaliers this fine evening. So
That's right. It's your Warriors are stumbling a little bit, trying to figure it out. We got a young Cavs team that we all think is going to be a very dangerous team in April and May. It's figuring it out right now. So
yeah. All right. Well,
right,
another
well-
show under our belt.
another one in the books. Many thanks. Any picks for NFL playoffs this weekend? My original prediction was Niners over the Bengals. I'm not wavering from that. Niners, big, huge. Bet them -4 this week. I like the Giants. Honestly, I love them plus the points and outright. Kansas City.
Can you place sports bets? You
Yeah,
personally?
in Ohio, it's legal now. Kansas City.
So if I said, Rich, can you put $100 on the 49ers for me just to beat the spread or whatever? You could do that.
Just send me one of the Nolan Ryan rookies, and it'll deposit your account.
We could talk about those next week. I have thoughts about my baseball cards.
And why
Thoughts?
the Bengals are getting 5.5. I get it. Their line's a little beat up. Burrow gets rid of the ball in 2 seconds. Bengals outright. Chiefs by a bunch. Giants in a shocker. Niner blowout. And Brock Purdy will be the Super Bowl champion and then a backup next year.
Wow. Bold predictions. All right.
All right. Well, happy Friday, everyone. Thank you. As always, we're here every Friday at 3 p.m. Eastern. Catch us on podcast, search TMC Connect, Spotify, Apple, or on YouTube. Until next Friday, have a great weekend, everyone. Take care.
See you
All right.
later.